Hi, it's Charles Thomas from Intrepid Eagle Finance, and I'm here today to talk about what occurred in the markets and the economy in the first quarter of 2024. And just to start us off, we always like to look at some things that happen good, but also temper that with some places where we have a little bit of caution that we're watching. On the positive side of things, to start off with, very strong quarter for investor returns, very good for the quarter. When we look at the large cap stocks, some of the biggest stocks that are out there, they've been driven for the last few quarters by this group of 7 stocks we call the Magnificent Seven. That has broadened a good bit. We'll talk more about that in a few minutes. And then when we think about the Federal Reserve, who is trying for this supposed soft landing that they're trying with inflation and what they're doing there, there's still hope with that, but there's some new information we need to know about that. When we look on the cautionary side of things to keep a balanced look, inflation continues to be a problem. It's lasted longer than a lot of the prevailing wisdom had it, and that continues to be a thorn in the side of the Federal Reserve, which is trying to get us back to their 2% target of inflation. When we look at just headlines, there's plenty of headlines out there that are causing concern for folks around the Middle East and around Ukraine and other things like that. And then when we look just again outside of the US, the Chinese economy is not giving tremendously positive news there. And it's a big economy, so that's something that does affect things. When we look at some other indicators for the first quarter, a few things stood out to me that I want to share with you here. When we look at the Federal Reserve's policy rate they've set, they still have this target of 5.25% to 5.5%. They set that in July of 2023 as part of their campaign to try to tame inflation. And we've been paused here for quite a while. At this point, what we're hearing from the Federal Reserve is they expect 3 interest rate cuts in 2024. This is notable because if you ask the same question before the year got started, they were predicting between 6 and 7 cuts. And that just has to do with how stubborn inflation has been and has not reacted in the way that the Federal Reserve predicted it would. When we look outside of the US, when we look at global stocks, returns were over 8%. Very strong start to the year. I'll take that any year. Looking a little more specifically, when we look at Japan, Japan hit a 34-year high. It's been 34 years since they hit their last high there. That's how long of a drought Japan has had. Very notable to look at. When we look at inflation a little more closely, February was not where we wanted to see that. It was higher than January. Again, went against the prevailing wisdom, not what we're wanting to see with that. When we look out there at the world bonds, 5.49% was where the 1-month Treasury bill closed in March. It's a very attractive yield compared to what we had for about a full decade with near zero rates. And we'll just have to see what happens to that. There's a little bit of risk around folks reinvesting that depending on what interest rates do from the Fed. Speaking of inflation, inflation continues to be a problem. Now, the good news is we're not anywhere near the levels we were at in 2022 and a little bit beyond that. We've come down significantly from that. That is the good news, and we can all celebrate that. What's not great is inflation continues to be stubbornly high compared to the 2% goal from the Federal Reserve. 2% is much closer to what we experienced for most of this century up until a couple of years ago. 2% is much more sustainable. It's not quite the uphill battle that we've seen with people reacting to inflation and having to deal with some of the negative effects of that. So we would all like to see it get back to that level. I'm happy it's not at 6, 7, 8% like we experienced for a while. We've improved, but this has not gotten back on track as quickly as the Federal Reserve predicted or wanted. But we'll have to continue to watch and see if their efforts bear any fruit. Now, when we think about just this order of things for how the Federal Reserve is approaching it, there's really 3 phases. Initially, we had this, what we call the pace, where they were raising interest rates on a regular basis. We were trying to watch how quickly will they raise them. They did that. Now we're in this place where they've taken a pause, and we've been in this pause for a while now, where there's been no change to interest rates. Eventually, what we're watching for is when they pivot and eventually begin to lower interest rates. That was originally expected to be much sooner than what it has been. So will it happen this year? They're saying it will, but you have to temper that with they said that would happen earlier. So we'll see if they get it right this time. Now, a lot of questions come up around the Federal Reserve is supposed to be a non-political and apolitical organization. So the question inevitably comes up, though, will they make changes in an election year? We're in a presidential election year, as you know, they get more press than the midterms, so it's a big year for that. Well, we never know what they're going to do in the future, but we can look to what they've done in the past to give us a little bit of insight to that. When we look at previous election years, including presidential election years, Federal Reserve has made changes to interest rates. They have not sat on the sidelines. So there's been plenty of examples going back over the past 40 years where they, even in an election year leading up to an election in those same months, they have moved interest rates one way or another. So given that, I have no reason to believe that they would refrain from activity just because of that. Now, one thing that inevitably comes up is when we feel passionate about politics, and politics is in the news, it does give us the temptation to make changes to how we invest based on our political leanings there. And I will confess I'm part of that too. I definitely feel that as well. But if we go back and we take the emotion out of it and look at how that would have worked out in the past, it paints a very clear picture for us. And that's why I like this chart. It's three hypothetical investing approaches. Approach number one is somebody who only owned stocks during Democrat administrations and sold when the other guy got in. The other approach is somebody who only owned stocks during Republican administrations and then got out when the coin flipped. And over the course of a century, if you compare those two people, they did about the same. But if we have a third hypothetical investor who just owned stocks throughout the same period, did not sell based on who won or lost an election, it paints a pretty big picture. And the lesson I would want you to take away from that, it's more important to stay invested in the long run as opposed to trying to time that around political leanings. Doesn't mean you have to like it. I'm not telling you don't be happy if you're not happy with that situation. But don't let that be the deciding factor when we're making decisions around investments. And just to take a little bit of a different tack to it, when we're talking about avoiding big drops in the market, we look at the last 16 presidents, none of them have avoided that. They've all had some sort of big drop that happened. None of them were immune from some sort of drop that occurred sometime during their administration. They've all had it. Looking more specifically at a couple different parts of the market, let's look at bonds first. So with the Federal Reserve, they held rates higher for longer at this point. Yields have gone up, so that interest has gone up around Treasury, corporate, municipal bonds. And then when we look at bonds outside of the U.S., same thing. Those yields have gone up. When we think about where we guide folks to invest, we still think that high quality bonds, so staying away from junk bonds or bonds with low credit quality, we want to stay away from those and stick to high quality bonds that are short term and intermediate term type of bonds. When we look out there at what we call the yield curve, it's still a strange world when it comes to that. So normally, the Treasury curve goes from lower to higher as you do that. So it's a way to look at it is If you're locking your money up longer in a bond, you expect to get paid more for it. And that hasn't been the case for a while. The treasury curve is what we call inverted, and it has been for quite a while. It's not what we would consider to be a normal condition. But that's the case here in the US, and we look at different parts of the market. It's generally the case out there as well. When will that right itself? Time will tell. When we look out at US stocks, I wish I could show this slide every single quarter. We can't, but I celebrate it nonetheless. All the stock indexes we look at in the US did well for the quarter, year to date, and then the last 12 months. When we look at a continuing story we've been watching is the concentration of the market. So what we've called the Magnificent Seven, these 7 different stocks that have done very well at the top of the market while the rest of the market hasn't kept up quite as much with them. Well, that's started to change a little bit when we look at the first quarter. These 7 companies, we look at what they did in 2023, they went up tremendously, and their peers at the rest of the market really just did not come along with them on that journey. When we look at this first quarter, that has started to come back into balance in a good way. Whereas last year we saw markets rise and it was very concentrated at the top. It was not a very, very broad-based gain in the market. That has changed to where markets went up in the first quarter and it was much more widely spread and much less concentrated toward the top. It's very encouraging to see. The earnings of a lot of companies went up during the first quarter to match that. So we feel good about that. So it's very heartening to see that start to become more broadly based and not so concentrated in those 7 stocks. So good news there. When we look outside of the US, stocks outside of the US went up as well. Another good story with that. Very strong first quarter, very strong 12 months. And the one downside here has been around the US dollar. And I'll explain what I mean by that. But that has impacted the returns of US investors investing outside of the US. Now, question I get sometimes is why invest outside of the US? Why do we do that? Well, the reason is we want to be diversified, but also there's growth that happens we want to be able to take advantage of. When we look at the 50 top performing companies and we look at where those are at, more than half of them are based outside of the United States. So we don't want to miss out on that growth opportunity and also protect from downside if, God forbid, in our country, we have a downturn. We want to be able to be more diversified across just that one locality. Now, coming back to the dollar, we have a double-edged sword with the dollar right now. The dollar is very strong relative to other currencies in the world. Now, that is good for us as consumers. As consumers, if we have a strong dollar, that means when we're buying goods from other countries outside of the US, our dollar goes much, much further. That's good for us. Where it's not as good is if you are an international investor, when those dollars get invested, they grow in the other currency, and when they come back home, so to speak, the exchange rate hurts you on that end of the transaction. Not tremendously, but it does make a little bit of a difference. That's something we do keep an eye on, and we want to continue to watch for that. But right now, it's very strong dollar relative to other currencies in the world. And just to close this out, just a couple of reminders I always like to touch on about the approach that I advocate for. So financial planning is a process. It's not an endpoint. It's important to start, but we're never done. We want to concentrate our efforts on long-term goals and objectives. We want to focus on reaching goals, not trying to beat an artificial benchmark. We want to maintain a disciplined approach during good markets and bad markets. We want to invest broadly and globally. The asset allocation that we have is very key. And we want to reduce investment and tax costs where possible. And lastly, we rebalance as necessary. We adjust and we rebalance as condition changes. So I want to thank you for joining me today. That was the first quarter for the market economy. Thanks so much and have a blessed day.